Good day to you all. My name is Paul Edwards. I'm one of the owners of Possibility Plus Financial Services. We help individuals find the right life insurance for your purpose. So we help you with term life, universal life, whole life, any type of life insurance policy, Keyman Insurance. We help you with annuities, that is investing for the future. We help you with long-term care. We help you with health insurance, and we also help you with Medicare. Today, I want to speak to you about whole life insurance. Last week, I spoke extensively on term life, and today I want to speak to you about whole life. And I'm taking this from Investopedia.com. Whole life insurance, how it works. What is whole life insurance? Whole life insurance provides coverage throughout the life of the insured person. In addition to paying a tax-free death benefit, whole life insurance also contains a saving component in which cash value may accumulate. Interest occurs on a tax-deferred basis. Whole life insurance policies are one of several types of permanent life insurance, meaning they cover you for your entire life. Universal life, indexed universal life, and variable universal life are other types of permanent insurance. You can choose a whole life insurance policy that works from one of these best life insurance companies. Now, so let me summarize that. So it's a permanent policy, which means most life insurance policies, whole life, index, universal, variable life policies. But today I'm speaking primarily to whole life. And next time I'll talk about universal life, index, variable. But with a whole life policy, it normally goes up to age 121 years old. So if you take out that policy for your grandchild and he's 1 year old, whatever the premium is, that will never change. So if you are paying $30 for a child policy, it's going to remain at 30, even when the child reaches 50 or 60. That's why many parents, they call it grandparenting. They take out these policies for their children and for their grandchildren. You can call me and talk to me about that. And so it's a permanent policy. Most people will say, I want to make sure that when I die, I have enough money to bury me and to leave something for my family. That's what a whole life policy does. So the difference between a whole life and a term is going to last for a period of time, but the whole life is going to last for your entire life. Now, a whole life policy, the monthly payment, you can pay monthly, you can pay quarterly, you can pay semi-annually, you can pay annually. You can also select how long you want to pay. You can pay just for 7 years, then you make no more payment. You can pay for 10 years, 20 years, 30 years. It's up to you. You have that option, or you can pay up to age 100. So it's up to you how long you want to pay into that policy. But the whole life policy lasts for your entire life. Now, with whole life policies, yes, they do contain a saving component, which we call cash value. There's a popular phrase which we are hearing today where they say, bank on yourself. And they are primarily talking about funding a whole life policy so that you can use the cash value that is built up in the policy to bank on yourself. That, in essence, is what they are talking about. So that's what a whole life policy is. So some very important points. A whole life policy lasts for the insured life, as opposed to a term life insurance policy, which is for a specific amount of years. Most whole life policy features level premium, meaning the amount you pay every month won't change. Whole life policy has a cash saving component known as the cash value, which the policy owner can draw or borrow from. The cash value of a whole life policy typically earns a fixed rate of interest. Withdrawals and outstanding loan balances reduce death benefit. So in other words, the thing with a whole life policy is that it builds this cash value over a period of time. And sometimes a situation might arise and you need some cash to borrow. So if you were to go to the bank and borrow that cash, the bank would lend you the money at an interest rate which you have to pay back. So then you have to pay back the bank that money and pay them the interest rate. While with a whole life policy, if you were to take the cash from that policy, then you just pay back the policy and the cash is always there for you to use in future. Plus, the cash value that is built up in the policy can also be seen as the surrender value. In other words, I always say this, most whole life policies, especially when you started young, after 20 or so years, with most policies, the cash value becomes greater than what you contributed to it. So for example, you were doing $100 per month, which is $1,200 per year. In 10 years, you would have contributed 12,000. In 20 years, you would have contributed 24,000. But what we tend to find with most policies, because of the interest that is added to it, plus the insurance companies that pay, because some insurance companies also pay dividends, and they add the dividends, so it grows by cash value and by dividends. So what we tend to find is that after that 20 years, even though you contributed 24,000, your cash value might be 28,000, which means if you were to say to the company at that time, I don't need this policy, you would get back, they would return to you more than what you placed in it by giving you the surrender value, which is what we call it, of the policy. So those are some of the benefits of a whole life policy. Many persons use a whole life policy because of the dividends. Remember, some companies pay dividends, some don't. So it depends on the carrier, the company that you are taking this policy from, right? And so with whole life policies, many persons use it strategically for different reasons. Whole life insurance guarantees payment of a death benefit to beneficiaries in exchange for level, regular due premium payments. The policy includes a saving portion called the cash value alongside the death benefit. In the saving components, interest may accumulate on a tax-deferred basis. Growing cash value is an essential component of whole life insurance. To build cash value, a policyholder can often remit payments greater than the scheduled premium to purchase extra coverage, known as paid-up additions, or PUA. Policy dividends can also be reinvested into the cash value and earn interest. Over time, the dividends and interest earned on the policy cash value will provide a positive return to investors, growing larger than the total amount of premium paid into the policy. And that is what I was saying, right? Remember, each company structure, that's why you have to talk to your representative to find the companies, because every company structure their whole life policies are a little different, right? The cash value offers a living benefit to the policyholder, meaning the policy owner can access it while the insured is still alive. To access cash value, cash reserve, the policyholder requests a withdrawal or funds or a loan. Withdrawals are tax-free up to the value of the total premium paid. Interest is charged on policy loans, which rates varying per insurer, but the rates are generally lower than you'd get with a personal loan or home equity loan. That's why persons, they say, bank on yourself. Because if you take out the cash value as a loan, most time the interest rates are lower than what the bank would charge you. And remember, when you borrow from a bank, let us say you borrow 50,000 from a bank. Yeah, and you have to pay it back. So you pay back the bank the 50,000 and their interest. Now, if you were to take 50,000 from your whole life policy cash value, when you pay that back, and you still have 50,000 there in the policy, that means if you were to surrender the policy, you would still get that 50,000. So a whole life policy can also be seen like you can compare it to a compulsory saving fund because of how the cash value works, especially if your whole life company pays dividends, right? Now remember, withdrawals and unpaid loans also reduce the cash value of the policy, depending on the policy type and size of the remaining cash value. A withdrawal could chip away the death benefit or even wipe it out entirely. So you have to understand your policy and understand how your policy works. That's why you have to talk to a professional like myself. So you can call me today. My name is Paul Edwards. You can call me at 321-557-1155. A cash value life insurance policy is similar to a retirement saving account in that it allows investments to accumulate tax-deferred interest. Part of each premium payment goes towards the policy cash value, which can be withdrawn or borrowed against later in life. The cash value of a life insurance policy grows quickly when the insured is young. But because more of the premium is needed to cover the cost of insurance as the insured age, the cash value grows more slowly as they get older due to the higher risk associated with age. The insured can access their policy cash value by borrowing against it, the cash value, or by withdrawing money in a partial cash surrender. Surrenders will reduce the final death benefit of your policy. You can also use the cash value to cover your monthly premium payments instead of paying out of pocket. Or you can surrender the whole policy to receive the entire available cash value minus any surrender fees. However, the policy will be terminated and the death benefit will no longer be available to your beneficiaries. So what they are saying here is there are different ways to access the cash value. You can take it as a loan, you can take it as a partial cash value, cash surrender, or you can surrender the policy. I remember a client of mine, he had a policy for years, but his death benefit, I think, was about $1 million. But he was overfunding this policy and his cash value had built up to over 500,000. And he was doing some business and he needed the money. So he surrendered the policy, took out the 500,000. This is how these policies work. The dollar amount of death benefit is typically specified in the policy contract, but can be changed in some instances. Some policies are eligible for dividend payments, and the policyholder may elect to use dividends paid up to buy paid up addition to the policy. which will increase the amount paid at the time of death. So in other words, with some insurance companies, you take out a policy for 100,000, it's going to remain at 100,000. With some insurance companies, they allow you to buy paid up addition. So you take out the policy for 100,000, but the paid up addition causes your death benefit to increase. So after 20, 30 years, your death benefit might have grown to 130,000, right? The death benefit can also be affected by certain policy provision or events. As mentioned before, unpaid policy loans, including accrued interest, reduces the death benefit dollar for dollar. Alternative, many insurers offer voluntary riders for a fee that secure or guarantee coverage, included the stated death benefits. Two of the most common such riders are the accidental death benefits and waiver of premium riders, which protects the death benefit if the insured becomes disabled or critically or terminally ill and is unable to remit payment due. So for example, with the waiver of premium, they charge you a fee, and if you got disabled or critically or terminally ill and you are unable to work, then the insurance company pays your policy premium for you until you can begin to work again. But if you can't work again, they keep paying the premium for you. So those are some riders. Beneficiaries may also have decisions to make on how the death benefit is paid. The default option is to receive a lump sum payment, but some policies also allow beneficiaries to choose to get the death benefit installments or to convert it into an annuity. An annuity may pay out for a set amount of time until the death benefit is exhausted, or it could pay out for life of the beneficiary. The death benefit continues to earn interest until it is paid, and that interest may be taxable. In other words, what they are saying, or what we are saying is, the beneficiary might say to the insurance company, don't give me the cash, give me an annuity instead. And that annuity will pay you a monthly payment for the rest of your life, or until the cash value is used up, depending on which one you select. As with any kind of life insurance, a whole life policies gives individuals and their families financial security against the loss of a breadwinner. For families that rely on the income of a single person, a whole life policy can provide financial security against the sudden loss of an income provider. But unlike term, whole life can be used as an investment. Once the cash value has grown big enough, you may be able to withdraw or borrow from it to pay for large purchases, such as a home. Some people also use whole life cash value to supplement their income in retirement when markets are low. Whole life insurance is also useful for businesses as a contingency plan for the loss of a key employee or partner. If a key employee passes away, a whole life policy can provide financial offset to the loss of their skills or expertise. If the deceased is a part of the owner of the company, a whole life policy can provide the remaining owners with enough capital to buy out the deceased partner's share of the business. Types of whole life insurance. There are several main types of whole life insurance, categorized based on how premiums are paid. We have level payment. Premiums remains unchanged throughout the duration of the policy. This is the most common types of payment plan. We have single payment. The premium insured pays a one-time large premium, which funds the policy for life. But this type of policy is almost always a modified endowment contract, which has a tax consequence. Then we have limited payment. As the name suggests, you may pay a limited number of premium payments, which will be higher than they would be at a level payment situation, but you'll only pay them for a certain number of years, 10 years, 7 years, 15 years, 20 years. You choose. Modified whole life insurance. The opposite of a limited payment policy. This type of whole life insurance offers lower premium than a standard policy in the first 2 or 3 years and higher than a standard premium in the latter years. It is more expensive in the long run. Whole life policies are further distinguished as participating and non-participating plan. While a non-participating policy, with a non-participating policy, any excess of premium over payout becomes profit for the insurer. However, the insurer also assumes the risk of losing money. With a participating policy, any excess of premium is redistributed to the insured as a dividend. This dividend can be used to make payments or increase one policy coverage limit. However, dividends are not guaranteed and often vary each year, as they are primarily based on the company's financial performance. Whole life versus term insurance. Whole life insurance is similar to a term life insurance in that both types of policies offer a payout upon the death of the insured. However, there are important differences. Whole life insurance offers a guaranteed death benefit for the entire life of the insured. A term life policy only pays out if the insured dies within a certain time frame, usually 10, 20, or 30 years. There are other considerations as well in order to provide greater benefits. A whole life policy requires significantly higher premium than a term policy with the same coverage limit. Whole life premiums are typically fixed throughout the policy duration, while term rate increased at each renewal as the insured grows older. So that in essence is what a whole life policy is. And so as I have said to you before, there are different types of policies. Last week I spoke about term. Today I gave you a synopsis of what a whole life policy is. Next week, God willing, I'll talk about a universal life policy so you can understand. The important thing, however, is that you must be covered. You must have life insurance to protect yourself, your family, or your business. So you can call me today. My name is Paul Edwards. You can call me at 321-557-1155. Let me repeat that. 321-557-1155. My name is Paul Edwards, one of the owners of Possibility Plus Financial Services.